Is ONEOK a buy or a sell? Let's get started with the model. This is a large cap company, 60 billion market cap. They're trading at 102 a share and they have 584 million shares outstanding. ONEOK is an oil and gas midstream company. It provides gathering, processing, fractionation, transportation, and storage of oil. It was founded in 1906, headquartered in Tulsa, Oklahoma. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went down from 1.8 to 1.7 billion. That's in 2022, up 66% to 2.8 billion in 2023, down 4% to 2.7 billion in the trailing 12 months. 14% margin in the trailing 12 months. That means they convert 14% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes up each year from 1.5 to 2.8 billion. 15% margin in 2023, down to 14% in the trailing 12 months. Revenue is the sales for the company, and that peaked in 2022 at 22 billion. It went down 21% to 18 billion in 2023, almost 20 billion in the trailing 12 months. And they do pay a dividend of 4%, which is actually low for a midstream company. It cost them 2.4 billion to pay that dividend, so they could only cover it 1.2 times with their free cash flow, because their free cash flow is 2.7 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value of sold cash flows past year 4, that's 85 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $75 billion. We divide that by 580 million shares. And we got a calculated stock price of 128. They're trading at 102, so they're trading at a 20% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 45 companies in the same industry as ONEOK, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 2.1 billion in capex. That's double the average. TC Energy spends the most, 5 billion. Their debt to equity ratio is pretty close to the median. It's at 1.7. For every dollar of equity, $1.70 of debt. They pay a low dividend for this industry, 4%. The average is almost 7%. They generate 2.7 billion of free cash flow, double the average. ET is number 1 at 6.8 billion. They rank 5th in market cap at 60 billion. Enbridge, the Canadian company, is number 1 at 88 billion. They're trading at 3.5 times book value, 21 times earnings, 22 times free cash flow, and 3 times revenue. All worse than the median, and also all worse than the average. They generate 20 billion of revenue, double Williams, a quarter of ET, but they're still growing. Their 5-year annual revenue growth rate is 13%. The average is 11%. They're trading closer to their 52-week high than their 52-week low, maybe about 9% below their 52-week high. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be pretty happy at $38,000 today, a 280% total return, a 14% annual return. I hope you didn't sell in 2020 because you would have been down, but then it came roaring back, higher than ever. To summarize, I have them trading at a 20% discount, ranking 7 out of 10. Would I buy a short term? Also 7 out of 10, but I think it's a better long-term trade, 9 out of 10. It's trading pretty close to its 52-week high. Ratio is 4 out of 10. They're all worse than the median. Financials are pretty good, 6 out of 10. Revenue isn't up that much, only up 21% since 2021. Free cash flow up nearly 50%. Let's take a look at their income statement. Here's the third quarter 23, third quarter 24. Revenue up a lot, from 4.2 billion to 5 billion. Commodity sales is up, services more than doubled. Let's see if they give a different breakdown of the revenue. Of the 5 billion of revenue, 3.9 billion is liquids commodity sales, 219 residue natural gas sales, 164 gathering, processing, and exchange services, 740 million transportation and storage. Because some companies want them to store the oil before it's delivered. Let's go back to the income statement. Below revenue is cost of revenue, 3 billion. Most of that is the cost of buying the fuel. They have to buy it before they sell it. You can see most of their revenue, 4 billion, is from the sale of the commodity. Only about 1 billion is gathering, processing, transportation, and storage. Then you have operations and maintenance, that's 500 million, up a lot from last year of 300 million. They have a lot of fixed assets, so they do lots of depreciation, 274 million, up about 100 million from last year. So operating income 1.1 billion, a big jump from 700 million. They earn 92 million from investing in other companies. They give a breakdown of their equity investments. They need to use equity method accounting if they own between 20 and 50% of another company. If you have significant influence on a company, you're supposed to use equity method accounting. Let's just say, for example, they own 25% on Northern Border, and Northern Border reported $100 million of net income on their income statement. Then this company reports 25 million since they own 25% of that company. But if they receive a dividend from Northern Border, that's reflected on the statement of cash flows. They had a gain of 23 million from the Overland Pass, that's in Texas. Saddlehorn, 13 million. Roadrunner, 9 million. Bridgetech, 7. MVP, 3. And all others, 12 million. And it looks like in March, they purchased an additional 10% in Saddlehorn, bringing their ownership to 40%. They actually operate the locations at Roadrunner, Bridgetech, MVP, and Saddlehorn. So they receive reimbursement for the operating costs and also receive a management fee. They also break down the 92 million. They had a loss of 1 million from gathering and processing, a gain of 24 million from natural gas liquids, a gain of 34 million from pipelines, a $35 million gain from refined products and crude. They have positive EBITDA in each segment, 1.5 billion of EBITDA, 624 million natural gas liquids. That's from 3.7 billion of revenue. EBITDA for processing and gathering, 318 million. That's based off of 900 million of revenue. Let's go back to the income statement. They have a lot of debt. They spent 325 million of interest on their debt, which is 50% higher than last year. Last year, 215 million. Pre-tax income, 900 million. Taxes, 219 million. So net income, almost 700 million. Last year was 450 million. And they added a lot of shares. Last year, 457 million, now 584 million. So they added 127 million shares. I guess that's okay because their EPS went up. It went from 99 cents to $1.18. I'd rather have $1.18 of earnings than 99 cents. Even though they're more shareholders, they raise their net income more as a percentage than they raise their shares. Let's look at the balance sheet. Current assets, 2.9 billion. Current liabilities, 3.6 billion, so a really low current ratio. It looks like they're going to have to add debt to get through the next 12 months. 579 million of cash, 1.25 billion of accounts receivables. This is how much money other companies owe them. Materials and supplies, 157 million. They have 616 million of inventory. Most of their assets are PP&E. For example, their pipelines, 40 billion. That was the original value of the asset. They depreciated 6.5 billion, so the book value is gross minus depreciation, 34 billion. They have 1.9 billion of investments in other companies, 5 billion of goodwill. Goodwill is from acquisitions. 1.3 billion of intangible assets. That's also from acquisitions. They have nearly 6 billion of cash they're holding for future acquisitions. Let's go to note B and F to find out what companies. Here's note B. This is the EnLink acquisition. In August of this year, we entered into the EnLink purchase agreement. They're teaming up with GIP, Global Infrastructure Partners, another midstream company. And they're acquiring GIP's interest in EnLink, which is 43% of EnLink's units. They're paying $14.90 cash per unit. MLPs trade units, not shares. It looks like they're paying $300 million for that piece of the company. The entire company is worth $3.3 billion. In October of this year, they purchased more of EnLink. Now they own 100% of that company. And they funded the acquisition from debt by issuing senior notes. EnLink's ticker is ENLC, market cap $6.9 billion. They pay a 3.8% dividend. And they're getting 13,600 miles of pipeline, 25 natural gas processing plants, and 5.9 billion cubic feet daily of processing capacity. 7 fractionators. A fractionator is a device to boil off the hydrocarbons one by one. In October of this year, they acquired Medallion. They work with GIP once again to acquire all the equity interests in Medallion for a purchase price of $2.6 billion. So their total assets, $51 billion, last year $44 billion. They have a lot of debt, 27 billion of debt. It went up a lot from last year because of those acquisitions. Assets minus liabilities equals equity, 17 billion of equity. They raised 16 billion from selling their business, selling units, selling stock, and they profited 1.2 billion from running their business. Let's look at the statement of cash flows. This is the trailing 9 months. They generated 3.3 billion of cash from running their day-to-day business. Last year was 2.9 billion, so up about 10%. They spent a lot in CapEx, 1.5 billion. They spent 400 million in acquisitions. Last year, 5 billion. Here are the dividends they received from their equity method investments, 55 million. Distributions received from unconsolidated affiliates. Because when a company uses equity method accounting, they're not consolidating their financials onto theirs. They're just reporting that company's profit or loss onto their income statement. Those earnings are not cash items, so they minus that out here. Since they reported a gain on the income statement, they reverse it out here on the statement of cash flows, negative 256 million. This is the trailing 9 months, so that's why the number is different than I showed you earlier. The 256 million is the trailing 9 months. We were just looking at quarterly earlier, the 92 million. So it's a gain on the income statement, a non-cash gain. That's why it's minused out on the CFO section. In their financing section, they paid 1.7 billion of dividends, up from 1.3 billion. They added 7 billion of debt. Most of that debt was for the acquisition, the Magellan. Let's look at Simply Wall Street. Its last price, 102, 60 billion market cap. Flat in the past week, up 44% in the past year. I wonder how ET did in the past year. Let's see. Up 42%. So it's pretty similar. They should move together. They should be correlated. Here's the stock price since they started trading in 1990. It looks like it was $3.58. It was probably higher. They just did stock splits, so it appears lower on this chart. Their stock price moves pretty close to the price of oil. If the price of oil was overlaid on top of this, they would look fairly similar. And the stock came down in 2008 or 2009. It fell below $10, a great time to pick it up. It went up 600% up until 2014, getting close to $70. Oil came down a lot in 2015, so did this stock, falling to around 20. Then it ran up to 75 in 2020. Then COVID and the oil crash in April brought it down to 20. And it's done really well since then. It grew from 20 to almost 120, a 500% growth. It's trading in the low 100s currently. Simply Wall Street's bullish on this one. They're at 150. They say the stock is 33% undervalued. 16 analysts priced this stock at 111. They say it's 8% undervalued. Their revenue back in 2013 was 12 billion. It didn't move too much over the next 7-8 years, up and down, up and down. Still around that number in 2021. Its peak was 23 billion in 2022. Now it's down to a little under 20 billion. They had 8 billion of debt in 2013. It was 13 billion in mid-2023, but they've added a lot of debt from those acquisitions. Now it's up to 28 billion. And their equity follows their debt, just a little below it. Right now their debt is 167% of their equity. And they don't keep much cash on their balance sheet, under 600 million. So they're going to need some help to pay the interest on their debt. They pay a dividend every quarter and they raise it each year, it looks. They were paying 60 cents per share in 2015. Now it's 99 cents. And this blue line is the yield. It was up to 13% in 2020 when the stock price came down. But as the stock price rose, the dividend went down. Now the yield is 3.8%. The forecast is 4.2% by 2026. The CEO's salary was $426,000 in 2021. Now it's $835,000. Total compensation $10 million, tenure 3.5 years. In the past year, one insider buy, one insider sell. 72% of the company is owned by institutions and 28% by the general public. Their biggest shareholder is Vanguard at 12%, then BlackRock. You have UBS, Morgan Stanley, Amundi, the French asset manager, Kane Anderson, and to round out the list, JP Morgan. Their employee count went up a lot from 1,900 to 4,800. The ticker trades on New York Stock Exchange, Deutsche Börse, Xetra, London Stock Exchange, Euro TLX, Wiener Börse, and Sao Paulo Bolsa. If you want to get a copy of my discounted cash flow model, watch the video in the top right corner.